Governor Viratai, distinguished leaders of Bank of Thailand, former governors, Kun Vijit and Kun Prasan, and a number of very old friends who I have grown up with, put it this way. It is indeed an honor for me to stand here at this prestigious Pheu Umpakon Research Institute for the Bank of Thailand. I want to pay tribute to the late Kun Pheu Umpakon because when I was a central banker at Bank Negara, he was already a legend amongst us. And recently, as you know, the Season Center ran a seminar specifically with the Bank of Thailand in his honor. And to me, I never had the pleasure or the honor of meeting Governor Pheu when I was at the central bank because he had already left. But there is, in life, always a point of connection. And the point of connection was that just as I was leaving Bristol, I graduated from the University of Bristol, my old professor from Oxford, Ezra Banathan, was a very close friend of Governor Pheu. And of course, when he went to England, if I'm not wrong, and this, unfortunately, I could not see it in his biography in Wikipedia, he was, for a time, a lecturer at the University of Bristol. And it was my distinct lack of faith not to have met the great man, because he was not just in charge of creating a great institution like the Bank of Thailand, leading it, but also, Thammasat University, which has led to so many brilliant young men and women in their careers in Thailand. So whatever I want to say, I think it is only befitting that I say this, with his spirit watching over what I have to say. Now, the point of this lecture, when Kun Pitit asked me to talk about this, I thought is a very important subject because we are living in a very unusual age. We are living in an age of major transition in which old theories don't work anymore. And as you know, the recent Jackson Hole seminar organized by the Fed last month was to talk about what is the future of central banking in this period of major change. And to me, the reason why it does not work is that we are looking at 21st century problems with 20th century glasses and maybe even 19th century mindsets. And we need new ways of looking at this, and unless we re-look at this in a different way, we will not be able to see the picture. Now, let me very quickly, just very broadly speaking, in the last 15 years, due to financial innovation, deregulation, globalization, and technology, things have changed beyond our normal understanding. And I have been in finance since I graduated from university. And these are due to megatrends, which I will describe later, which therefore requires a very major change in mindset, governance, new measures of interconnected behavior, and new data sets. And you cannot do research unless you use new data, because when things happen, it's like a person who looks for his keys in the dark under the lamp. Where there is light, you keep on looking for the keys, you forget that the keys are actually outside in the dark. And that's exactly what is happening right now. We cannot understand this unless we look at it in a very different way. So the reason why we got into what happened was that our conventional theory was talking about the great moderation. And as you know, the person who articulated this was Governor Ben Bernanke. In the 2002, 2003, he talked about how we seem to have conquered a world of growth with no inflation. Central banking has succeeded. And of course, by 5 years' time, 2007, everything that you believe in the moderation went into the world's greatest financial crisis that we have seen. And what is the explanation of all this? Two of the best economists, financial economists, Mervyn King in the Bank of England and Ben Bernanke in Fed, basically said in their retrospective, which you can easily read nowadays, is that they ignored radical uncertainty. Hello? Radical uncertainty has always been there. It's only whether you choose to see it or choose not to see it. So we are living actually in a world in which economics, in trying to be a social science, has forgotten about the origins of economics, which was a political economy. And that social science is not natural science. Natural science is about what happens outside man. But with human behavior, if I do not know what you are thinking, and you do not know what I am thinking, that is already radical uncertainty. So how can you exclude radical uncertainty out of basic social science? The whole premise of this was wrong. And that's why we need new economy, needs new data and new interpretation tools. So very quickly, let's go back to where the problems really lie. The problems lie because we were, as central bankers, in charge of the formal banking system. And then, when the crisis occurred, we realized there was a nexus, an interconnection between the formal banks and the non-bank financial industry, which we call shadow banks, right? And it was the interaction between them that nobody saw, and this lack of measurement of the embedded leverage. If I borrow, but I don't want you as a financial regulator to know about it, I put it off the books into a special investment vehicle. And if you want to look into the investment vehicle, I put it offshore where you have no power to look at it. Okay? So the result was that it's not just a national balance sheet, but the global balance sheet has gone out of whack. And nobody looked at it because conventional economics was all about flows. So what is this radical uncertainty that we are concerned about? Well, it's all about unknown unknowns. And there is that the first premise is about perfect information. All the theoretical models, the dynamically stochastic general equilibrium models, is founded on this basic premise of perfect information. And perfect information is, by definition, 1 out of 10 trillion cases. And on that assumption, you build all the theory, so that ultimately, with perfect information, you have best outcomes. You have optimal. But in reality, there is no such thing as optimality. Everything is a choice of different unknown outcomes, right? So if you move from perfect information, you get to known knowns, something you already have experience of. You know about it, and you know about it. But there are also known unknowns. We think about a black hole, right? We know that it's somewhere out there, but we have very imperfect measurements of the black hole, okay? And then there are knowable unknowns. People like Andrew Lo from MIT, and Ricardo Hausmann and a few others, they have now begun to use big data from anywhere to calculate all this. And the unknowns that we do not know can be computed up to a point. And then there is this fully unknown. We don't even know that we don't know. And that is something that you have to accept. And why is it that we need capital? Because if you have perfect information, you do not need capital. Everything can be borrowed because I know perfectly what my risks are. I do not need to have capital as a cushion against unknown unknowns. But the minute you accept a perfect information system, you can increase your leverage larger and larger because it doesn't matter, you know about it. But if there's unknown unknown, you must have sufficient equity cushion. And that's why in this very simplistic way of thinking about this problem, we got into this financial crisis. So we need to appreciate that the structure of finance is changing. You know, that everything we have understood about finance, including its basic principles, is very fundamentally problematic. Now, where is it problematic? Firstly, there are at least 6 mega trends that are changing finance. And a very famous analyst, basically said recently, and I agree with him, he has never seen the level of uncertainty that he has seen today. Because there are moving parts everywhere that are changing, and we literally do not know which will come out. Who would have expected that Donald Trump could be even a serious presidential candidate? Right? Now, the fact that this can occur and that all the experts did not predict Brexit and it occurred shows that there are levels of uncertainty that we don't know about. The first one is that there is global balancing. We have moved from a unipolar world dominated by the United States to a multipolar world, which there are huge geopolitical risks. We don't know what's going to happen in the Middle East. We don't know what's happening in the South China Sea. We don't know what's happening with North Korea. We don't know what's happening with Ukraine, etc. Any one of these can change the game. In fact, this failed coup in Turkey has realigned the geopolitical situation in the Middle East. Secondly, is demography a dividend because we are lots of young people, or is it a burden as we are now seeing in Japan? Well, if you think about the Arab Spring is about 3 things. High birth rate, 20 years later, high youth unemployment, and number 3, incompetent governments who cannot provide enough jobs for these young people. And so you get a big problem on your hands. And then the third issue is about financialization. We have higher debt than ever before around the world, right? But ultimately, who's going to pay for this? Fourthly, we have disruptive technology. It's wonderful to have robots. It's wonderful to have new biotech stuff. But robots destroy jobs. And are we worried? And then there is climate change. As you know, we are going through the biggest El Nino, and now the El Nina is coming. And recently, as you know, there are now salinization and drought in parts of the Mekong Delta, as well as in India, etc., and in Africa, which is now causing major food and energy stresses. So is inflation a potential risk that we need to think about? And finally, there's this demography issue. But the bottom line really is this: can central banks, through their unconventional monetary policy, deal with this issue? So this is a risk map presented by the World Economic Forum, showing how everything is connected to everything else. It just makes you see how complex it is. Now, if you want to think how the nexus between the banks and the shadow banks, you just have to look at this whole, sorry, this is not a pointer, but this is the pointer, yes, I beg your pardon. So you just see how the shadow banking, works with the banking system, right? And if you want to then see how the shadow banks transform short-term funding to the long-term sources of capital. But the problem is that the long-term sources of capital, particularly the funds and the hedge funds and the pension funds and the insurance funds, they are losing money. So the zero interest rate policy is destroying the business model of the whole banking system. Who in their right minds would give an asset manager 1 to 1.5% interest rate, administrative fee, when the expected return on risk-free asset is 0? Answer, you can get a very high return if you, as a saver, take high risks. So recently, my private banker told me, Andrew, you can get 4% return if you put X amount of dollars with me, I lend you 5 times that dollars, put it with a bank that I take high risks, and then if the US raises interest rate, I lose all my money. But I can still get 4% interest rate. Now, so it goes to show that the system is really problematic. But how does it all tie together? The big problem is that we're looking at this problem as a silo. We all look at this problem in our own narrow field. Every department, even within the central bank and within the government, every department will tell the boss, whoever is the boss, if you give me more money, if you give me more resources, I'll solve the problem for you. Answer is wrong, because if you do all this together, it does not add up. This is the fallacy of composition. And the fallacy of composition lies because we need to deal with individual banks, which is microprudential policy. We need to deal with financial system, which is macroprudential policy. We need to deal with the economic system, which involves monetary policy, and we need to deal with the international architecture, which deals with exchange rate and financial architecture, global financial architecture policies, right? So we need to think systemically how everything acts together, both the macro, which Krugman, or I think Krugman was the one who said macro theory is at best useless and at worst harmful, something like that order, right? But anyway, we all learn mostly micro, but we forgot the link between the micro and the macro is mezzo, the institutions, okay? And the institutions are which is created for us to deal with uncertainty. Human beings created a social society of institutions fundamentally to deal with uncertainty. But they created a Frankenstein because all institutions have become vested interests, and they do not necessarily look after the public interest in itself. And that itself is a problem. And that's why we need to think about the meta. What is the thinking behind the thinking? Why do you think like that? And you realize he thinks like that because he or she has very different values, very different experience, very different information, and therefore he or she behaves very differently. So if we don't understand the meta, we don't understand that the macro is not equal to the sum of the micro, we need to rethink from a mechanical basis to a very different basis itself. So, as I said, the big problem is segmentation and specialization versus an integrative system-wide view. Central bankers are the only institutions within the nation that has the capacity to think out of the box. I'm not saying other institutions don't think out of the box, but because we are in charge of the financial system, we have to understand not just the financial system, but also the real economy. And then how the financial system plus the real economy interact with the rest of the world. So banking is global in life and national in death. Ultimately, you can talk about globalization, but ultimately, it is the nation that pays. So we need to look both deep and wide. I think about this problem, about silos, like the world is a Swiss cheese. Every silo says that if I drill deep into this cheese, I will solve the problem. Ultimately, the cheese is so full of holes that it's become fragile and will implode. We really need to think both deep and wide, and we need to think very differently about these huge problems. So we have different macro and micro prudential issues that you need to have, and I don't want to go into these technical issues of how you deal with this, but to look at a very difference between the static mechanical view and the dynamic organic perspectives. The static national macro view is that if a bank is sound, the system will be sound. If you have more and more trading, everything will be fine. And you just only focus on above the line exposure, netting will reduce risk, segmented prudentials apply more new rules to fix old problems. All of them are wrong. All these are assumptions. They are not facts. The crisis demonstrated that even if institutions are sound, the dynamic feedback between them can cause instability, which is exactly what's happening. If there are two persons who are both fit, but the two of them fight each other, and the society is just the two of them, the whole system loses. So just because that they are fit at this point of time doesn't mean that the system is stable. So we need an oversight of all these, and it's no longer about netting. The net, we netted out the financial system. The financial system, the reason why the finance is not part of the DSGE model is because finance nets out to zero. But actually, that's exactly where the problem is. And when you have no liquidity, you find that it is gross that kills you, not the net. So we need now to operationalize macro pool work, and this is how complex it gets, right? You need to understand this, and I won't go into the detail, but I'd be happy to talk with you how this all links together. So on the issue of global finance, how do we look at it as a whole? Well, global finance is not equal. The biggest wrong assumption that we make, it's only a convenience, is ceteris paribus, other things being equal. But other things are not equal. Other things are not equal because you look at it. If you look at the way the global trade network is done, China is at the center of this, US is, and they're huge. And so the top 5 banks normally account for 50% of the assets and more than 50% of the risks. And if that top 5 bank goes, the whole system goes, right? So networks are highly concentrated. The banks have become internationally more exposed, since even 1999. The financial debt has grown 5 times GDP. Finance is larger than the real sector. The overall financial system is far more leveraged compared with the households and the governments, right? And in order to bail out, and banking assets now account for half of global financial assets, but central banks are now 1/8. Now, before the crisis, central banks was only 3% of the global financial assets, is rising to 8% and growing higher. So the basic problem is that the global credit, and the co-writer with Kun-Pittit, the Borio and Pittit articles, is that it's not just about the excess savings, but it is about excess credit that is the risk of the system, is what I buy. It is that, we have created a system because the prime brokers have become too big to fail, too big to manage, and the system has become too fragile because the credit is always in the system. The finance has become faster. The global SIFIs have become even more concentrated than before. Before the crisis, in 2002, it was half, and today it is more than 2/3 of GDP. And then the measures of shadow banking is growing significantly. Now look at the difference. In China, the shadow banks, why did the shadow banks grow in China? It is because the interest rates on shadow banks is so significantly higher than the official rates. So if you keep the official rates low, the system is problematic. And this is the net versus gross problem. If I borrow, I have an asset. If you net it off, my net exposure is 0. But if you don't pay me, I can't pay him. And if one player in the system dies, I die, and the other guy also dies. And that's why this netting idea is very problematic, and that's why they moved it all into these G-SIFIs who are doing all these I beg your pardon, sorry. I beg your pardon, sorry, I lost this, yes. Now, so therefore, we need very different measuring and statistical systems to monitor dynamic systems. And the point that I want to make for you is that we need balance sheet data for real estate values. And why do we need real estate values? GDP, if GDP is 100 in the United States, real estate is 250% of GDP. So during the subprime crisis, the United States households lost 50% of their net worth, when the system hit. So we need to understand that real estate is critical in the whole system. And normally we have very little data on the real estate other than prices. So the gross savings, also really matters versus the impact of the real sector, impact of the financial system. You can see that the impact of the financial system is very large, in the crisis economies. Now let's very quickly go into the central banking and unconventional monetary policy. Central banks used to work in a system in which the real sector was very stable and the financial system was by and large stable. Capital in the 1940s of banks, the 1930s and 1940s, was equivalent of 15% of their book. At the crisis, it went down to 2%. So the financial environment, the change has changed the central bank functions completely. And basically, central banks have begun to understood that central banks affect the economy through changes in the balance sheet of the central bank. Okay? Now they change this through inflation, the credit creation, and the recapitalization of the banking system, especially through interest rate subsidy. Because the lower interest rate create losses in long-term holders, but benefit the borrowers. But if we benefit the borrowers too much and the borrowers do not use the money, take Apple, take Google, they all keep large cash in the system. So the central banks, after the global crisis, have been expanding their balance sheet very significantly, advanced economies, through somewhere like $10 trillion, and emerging markets is about $8 trillion. So as percentage of GDP, the central banks have now moving from, roughly 40% of, I beg your pardon, I'm sorry, I keep on moving this too fast. Maybe I'm stopping you from going to lunch. So, but very quickly to run this. So the central bank's assets are rising and interest rates are staying low. And if you have time, look at this data. During the net worth of the households in 2008, look at the households. They lost 10 trillion in net worth. And the average change in net worth of GDP was 51% of GDP. So between these two periods, they lost nearly 90% of GDP. So are you surprised they went into crisis? But the US net worth is now going back to before the crisis levels. But this is only because it is sustained by unconventional monetary policy with very low interest rates. So what are the implications for Asia? Well, if we just follow the Taylor rule, we need higher interest rates. But we can't get it because if the advanced country keep interest rates low, we can't raise the interest rates without getting huge capital inflows, right? And the result is rising volumes and lengthening maturities. The duration is getting longer. People are now selling very long-term debt at very, very low interest rates. We're building the risk in the system. And the non-financial corporations are large issuers of this debt and keeping a lot of it in cash, waiting for the market to change. So the EMEs need very different approaches. The advanced countries, because they're the big boys, will do whatever they want to do. But we are the small countries. We have to live with them. So it is so, the simple way of, let me think about this. I'm sorry I keep on repeating this, although, today I think more or less everybody accepts this, that Basel III is cancer medicine for those people who have cancer, but if our big problem is too many mosquitoes and malaria, why are we taking cancer medicine, right? We need rules in terms of principles that are easy to learn, easy to comply, easy to regulate, and accountable. And therefore, we need, rules that fit us. It is not about best practice, it is about best fit. Now, how do we deal with systemic risks? The systemic risk is not something you can change overnight. And I think, the advanced country, the central bankers and the economists, they have very complex systems, very sophisticated. But, banks are IT systems. We cannot change so many different rules without suffering from huge operational risks, right? And the easiest thing for a regulator to do is just to change more, to write more laws and write more rules, which banks, have difficulty dealing with. So what we really need to do to think through is that the real economy will only heal when the bankers, regulators, and the politicians are on the same page to get growth going. This is why central bankers are like gardeners. We need to make sure that the garden prosper in a stable environment, not when we ourselves are adding too much fertilizers, right? This is what is very, 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 very critical. We need a very different way of looking at the whole system as a whole. Now, that means if we need a very different way of looking at it, we need new ways to measure the economies. So if you look at the way the data is going, everybody's changing the data. Some people, say that the Chinese data is wrong, but you need very different types of data to look at where things are going. So if we look at the geography of complexity, you will see that very complex economies, are very highly knowledge economies. Relatively less advanced economies are relatively simple economies, right? And therefore, so basically, Ricardo Hausmann Hidalgo has been using an atlas of economic complexity to describe this. And he did this by looking at product space. Production is all about supply chains, right? Thailand is famous for its, global car manufacturing supply chain. And nobody expected that when Bangkok went under flooding, the global motor car components could not complete on time because they had to dive underwater to be able to get some critical components working. So it goes to show how everything is complicated, related, and we need to look at how everything is related to everything else. So how do we think about this for Thailand? And if you look at this, you realize that Thailand is actually increasingly a more sophisticated economy, that it ranks 26 out of 124, and it's rising in that area. The fact that I see, nearly 400 or 500 people here in this room show that all of you are interested in this complexity. We need to think about it very, very differently. So let me very quickly come back to this summing up of what I want to say. We are living very much in a world of huge complexity, that everything is related to everything else. But we need to think about in a simplistic way. And when we need to think about in a very simplistic way, we go back to our own philosophies. Many of us here are Buddhists, okay? Why do we need to go to a temple to meditate? It is we want to clear our brain of too much complexity and focus what we think is important for our own happiness. Now, the world is becoming more complex. We cannot deal with all this complexity, but we need that simplicity to appreciate what is important in life, what we need to deal with. Well, central banks do it the same way. We reduce everything to affect the short-term interest rate to affect the whole system, and then we support it through bank supervision, regulation, and other tools, and affect it through our balance sheet. A very complex problem is reduced to very simple Taylor rule. But these rules in their own could be wrong, because we come back to Goodhart's law. If you choose a very simple thing to be your proxy, society will change its behavior around that proxy so that proxy does not work anymore. And we must be humble enough to understand that life is all about change, and is it constant changing. So it is that change, it is because the world comes from uncertainty, because uncertainty comes from the interaction between different human beings. That our individual behavior is different in a crowd, and that the crowd changes behavior under different issues. So we need to look not just at the old ideas of flows, what is revenue, what is profit. We need to look at balance sheet. We need to look at off-balance sheet. We need to look at the system as a whole, and we need to understand that the system is much more complex than we understand. We must be humble enough to accept this. We must be humble enough to accept that, yes, we will do whatever it takes, but central banks cannot do everything. That central banks can only work as part of society. And that if society wants to go one way and central bank wants to go the other way, it will not succeed. So how do you lean against the wind? It's not a science, it is an art. And so therefore, in this context of central banking, I think it's very useful. The only thing that I can give you before lunch is not to think about food. I said this recently to the bankers in Singapore. This is global banks, this is international. I said, we are just on the point of taking lunch. Did you realize that under unconventional central banking and unconventional monetary policy, central banks are taking away your lunch? The regulation is squeezing your lunch. FinTech is eating your lunch. And some of you are still out at lunch. So on that note, let's go for lunch. Thank you very much indeed. Do we stop here, or do we want to ask questions? I have some time. Kun Piti? Piti? If not, we will go for lunch. Kun Piti? Sorry? Anybody can ask. Let's ask one or two questions. I have time. No? I think Thai people are very polite. Yes. Computer. Oh, sorry. The mic. Can you please get the mic working?
Well, if you insist on a question, I think one thing that we have been thinking about a lot in Thailand is the rise of financial technology, and that's a very information-intensive business. So China has gone a long way on this route with the shadow banking. It's actually fintech driven in some respects. Would you have any wisdom to share from your book, say, about the data either abuse or the data needs that is required to have a successful fintech sector based on the experience of China?
Okay.
Thank you.
When they use the word fintech, they confuse two very radically different concepts. The first is about startups. A lot of startups are young, maybe even experienced bankers who says that with this technology, I can evolve something that will reduce the cost of financial transactions very fast. That is the startup fintech. And then there is what I call the giant fintechs. What banks are worried about is not about the startups. They are actually they should be more worried about the giants like the Googles, the Facebooks, the Apple Pays, the Alibabas of this world. Let me put it in context, okay? You know that any of the fintechs, the small startups, many of them will fail, okay? Out of the 1,000 fintech startups in Silicon Valley, maybe 2 or 3 will become unicorns. That means they will reach 1 billion in valuation, and the next year, some of them will drop to 0. Okay? So the big banks are not worried about these guys. What the big banks should be worried about is the Googles, Facebooks, and the Alibabas of this world. Now, why is it? It is because banks and financial institutions are networks. And networks are all about concentration. The top 2 or 3 banks network everybody, okay, between them. And what is a telco? A telephone company is already a network. A telco, technically speaking, is already a bank, because at the end of every phone that you have is a deposit. The only reason that you cannot use that deposit of a telco to transfer resources is regulation. You get it? So, actually, the banks face the biggest competitor, technically speaking, that is stopped only by regulation is the telco. So what was the big innovation? The big innovation is the Alibabas of this world. They came along and they sit on top of the telco because Alibaba does not run its own computers. It sits on the telco network to run its platforms. And the Alibabas of this world is not a single-sided platform. It is not a bank. A bank is single-sided because all it does is to do the finance side of the customer. What Alibaba does, and Facebook can also do this, is that it sits on the platform that is multi-sided. It has networked the production, the distribution, and also the individual using big data. Google knows more about you than even the government. On the Google iPhone, they even know when, sorry to say, you go to the bathroom. Right? Because once you say, know your location, they know where you're going. They can track you. So if you buy anything, they actually know how much you buy, what you like. Amazon knows what book you bought, what type you buy, and therefore they can suggest what you buy. They can manipulate that information. So the big guys are the big fintechs. Now, if that happens, and I give you a very simple illustration, at a situation of 0 interest rate, if Amazon.com says, you open an account with me, okay, you can buy anything of the world you want me through Amazon. I'm just using Amazon as an example. Instead of giving you an interest rate on your deposit with me, I give you a 5% discount on anything you buy on Amazon. That 5% is higher than the deposit interest rate that you get from the bank. In fact, the banks charge you for transactions, whereas the platform does not need to do this. Can this succeed? So the finance industry is under huge siege because the world is changing at super speed. Now, how does compete? You asked about China. In China, fintech in China move faster than the United States because of regulation or lack of it. The regulators in China do what I call, I cannot put that in black and white, one eye open, one eye shut policy. Because basically they realize that if China does not innovate, it cannot succeed. So they allowed people like Alibaba, Tencent and all these, to move into this space experimentally. But there is, of course, a cost. There are a lot of fraud, P2P fraud that we've now seen. But at the same time, they have created, multi-sided platforms, which is brand new in the system, and they can reduce the transactions costs of transacting because through one platform, any individual today, if you know how to use it, any Thai in any village with access to internet can trade with anybody in Africa, in Latin America, because you've created a global market. So fintech is changing the game. The only problem is we don't know how it's going to change. Because the big problem today is that even the advanced economies don't know how to deal with this problem. Because they are blurring the lines of traditional segmented regulation. Technology has transcended geography, literally flattened the game, so that the huge giants like Amazons of this world, like Alibabas of this world, will increasingly dominate the way we do business and the way we transact in the marketplace. And that has changed the way that we as regulators, including as central bankers, should think about this. Just think about it. Even things like blockchain, which is considered illegal, basically has bypassed central banking as final money. So, we need to be open-minded to understand that in today's world, we need to look at these threats as well as opportunities in a very realistic manner. But I think I've given you enough food for thought, and I think we should eat for lunch already. Thank you very much for your patience and your understanding.